tool that I like to use is called the Williams %R. And I'm looking for extreme readings, and actually I'm going to show you how I actually use them. It's very similar to stochastics in measuring overbought and oversold levels, but I do things quite differently. I actually like for stocks to be overbought if they do the right setup, which I'll tell you about in a second here. But Williams is a little bit of a different scale. His traditional scale is from a peak of 0 down to a bottom reading of -100. On some scales like stochastics and RSI, they usually go from a low reading of 0 up to a high reading of 100. So from 0 to 100 is the usual scale. He actually goes from -100 at the bottom up to a maximum reading of 0. So that's something you just have to adjust to. But if you have a 0 to 100 scale, it'll be a little different than a -100 up to 0. So, but that's what this is based on. Just remember, -100 is the lowest reading, 0 is the highest reading. So we're in that kind of a scale. While most use a 10 or a 14 bar setting, I like the 30 bar setting. The 30 bars, and a lot of testing I've done, is a smoother ratio than the 10 or 14 bar setting. Remember, if we're using days, that's 30 days. If we're using hours, that's 30 hours. If we're using monthly, that's 30 months. So, you have to, it adapts no matter what time frame I'm trading. 30 bars is very smooth, but still very responsive. It's not going to be as lagged, in my experience with %R, as some other oscillators are. So, what am I looking for here? Well, I actually, for a bull trend, believe it or not, this is the exact opposite probably of what you've been taught in other texts by other gurus, but the idea is that I want a stock to go overbought above that top 20% threshold, which in this case, remember, 0 to -100 scale, -20 is actually in the top 20%. So if it goes above that -20 threshold into that upper 20th percentile, that's what most people would call overbought, and they wouldn't touch it. But actually, guess what? If it goes above that bar's high with a close above that bar's high, that's what I'm looking for, preferably for me in the next 5 trading bars. So if ideally, when they just keep on going up, it's not the top of a trading range. You should not sell this kind of a market. In fact, you should buy it, in my experience, if it, in fact, keeps going up even after it gets, quote-unquote, overbought. So that's what I'm looking for. I'll show you some examples of that. And in contrast, bearishly, if I get an oversold reading based on the traditionalist definition of oversold under the -80 threshold, so remember, on a 0 to 100 scale, we're now down in the bottom 20% at -80 or less. Then if I go below that -80, then I get whatever that bar's low is on the price action. If we close underneath that, not intraday, but close in the next 5 bars underneath that bar's low, then that tells me this thing is not a buy. In fact, it's not the bottom of a trading range. It's the start of an unusually strong bear trend. And I'll show you how we manage our way in both the good trades and the trades that don't work to get out quickly when it's not working, but also ride it when it is working. So here's a bullish example, and this is MasterCard. MA is the ticker symbol for MasterCard, of course, the credit card processor. And what you see here is that we have a situation in which I'm just looking at %R in the top half of the chart. We've got the upper overbought threshold defined as this upper flat blue line here. And you can see that on the bottom chart, we just got the price action with your up candlesticks in the greenish color, your down candles relative to where they open in the reddish color. And so from that perspective, what I'm looking for is when this thing gapped up on MasterCard, it had good earnings at the start of May. This bar's high was actually the first setup. We first crossed above the -20 overbought threshold right there on this bar's high. So what that means right here is that I need to see a close above this bar's high. We might trade above it and then flip back down. That wouldn't count. It's got to close above that high. In fact, it did. It closed the very next bar up here at about $135. So this next bar here in early May, it's bull confirmed. So that's my first bull confirmed buy when it goes bullish above that overbought threshold. Now notice as it comes back down and then it tests just under the overbought -20 threshold, I've got it labeled here as a bull retest. You know, when I used to first trade this, I used to get out when it was coming back out of the overbought mode because I said, well, I'm telling myself I want to trade it when it's overbought, but it's not overbought anymore. But what I found was through many periods of testing, through trial and error and then a lot of testing, that these low points, if that day's low is not violated on a future close, then we're okay to hold on to that position. In fact, it's usually just a fake out of the weaker bulls saying, okay, everybody thinks, oh, this trend looks like it's turning, but in fact it's just a retest. That low holds the next couple of bars here. We have a couple of tests below it during the trading days, but it reverses and closes back above there, May 14th, 15th. And you can see that then it's off to the races again. So instead of waiting for this thing to confirm and buying it back up here again, you're actually able to reset your stops if you're already in the trade. Or if you're not in the trade, you can actually put on a trade here using this low on the next bar where you know that it should not close below this bar's low from the 14th, which is, again, back in the $135 range. Well, so you see it then trend all the way up to about $155. And then, boom, we get this quick slam down back under the, minus 20 overbought threshold, right on this nasty bar here, where you had the stock down about 7 points at the end, that nasty red candle. Now, a lot of candle followers might tell you, well, that's negative, watch out below. But I'm saying, actually, I like to buy into the teeth of that. And we, in fact, did buy in my Option Shark service some little more aggressive calls out into July. We bought July 150 calls, and the stock was trading about 140, just a hair under 140. You think, well, that's not what I was just talking about. Well, yeah, you could also buy the 130 calls, which would probably be the safer play, but that other service is a little more aggressive. But the point is that I was saying, look, this is a great entry if we don't close below this low, which was $138.10. Well, the next morning, the market's weak there in early June, and the stock gets whacked down about $135, down about 3 points below the closing stop. I've learned, as I'm sure you've experienced, the pain of getting whipsawed out by intraday stops, interbar stops, and so you've got to wait for the close. So you can see the close here happens. We close back up above that low, back around $143 and change. So we hold above 138 on the close. So if you'd have just overreacted based on the intrabar action, you'd whipsaw yourself out. That's why you can't do that. So even though we're below that overbought boundary, what matters to me is that we hold this closing low. So from that point, then we start to see it trend back up. And based on some of my other indicators, I ended up selling about in this area for, on average, about 150% gain on the whole position. It did go up a little bit more, but, you can see that if you were just following it through on the retest, the next retest happens right here. And, you can see that you could either add a position there or you could just reset your stop on your remainder. Usually, as we'll talk about, we like to take a double on half and try to let the rest run. This would be your next retest, but your next tightening your stop point. I recall that was about $160.65. Then we get another retest up here about the 161 and 161.7, I believe it was, on this retest right here. But then, unfortunately, the next bar, it tells you, okay, you've got to get out. And I shouldn't say unfortunately, because you're locking in a very nice profit at that point off of the several entry points along this bigger trend move here for these 2 months of May and June. So it tells you you're done here. And so then you've got to see, after you get one of these breakouts, you've got to see it close above that next high. It doesn't happen. So you're exiting as the close is below the retest low. We close about 161.5 versus 161.7. Even if it closes below by a penny, I just get out, because the best setups, they may have one of these bend but don't breaks where you try to test it during the bar underneath the stop, but then you reverse it back above it. That's just flushing out the weak holders and the stops. And then the good ones will move on up, versus the bad ones, if you break it, it could keep on dropping, or if it does bounce, the bottom line is you don't have an edge in that environment. So this is not a valid retest here, because we're not getting a bull confirmation on this attempted move back above the overbought threshold. So that lack of confirmation is what saves me many times from getting whipsawed. So that's why I required the confirmation. You can see that since then, MasterCard, the rest of July, started to trail down, tried to bounce, and then drop back down. Bottom line is, no opportunity there for us. We have locked in our profits, and we've moved on. That's the case on a bullish trend. As I mentioned, how to stay with big winners. What I really like to do is give myself a chance to stay with the bigger trend by just taking half of my position profits if I can get a double or more. As a general rule of thumb, that will allow me to maximize the total trade, because I'll be able to ride those big trends that they don't happen, the majority of the time, but when they happen, they're going to carry your portfolio. And at the same time, you've gotten your risk capital back. Why? Because you've allowed yourself to release the fear of giving up your profits that we all have when we're in a profitable position. Most people tend to give up their profits or take their profits much too quickly. And from that perspective, you get rid of that fear. Now you've gotten your initial investment back. You've got all your risk capital back. And now you're basically trading with the market's money, if you will, but it's still your money. The point is that even if the other side went to nothing on some kind of bad news, you'd guarantee at least a break even, but we don't want to just do that. We want to ride the indicator through to its ultimate completion, or while we're riding, if it either gives back half of its gains from its peak gains, so say it's up 200, then it goes back to only up 100, that would be a spot to get out relative to its peak gain, or exit half again if it later doubles once more. So you buy the option for, say, $3, $300 a contract, and it goes up to $6. You sell half